This podcast is intended and contains general information on financial strategies, investments and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hello and welcome to another episode of Wealth and Toil. My name is Luke Laretive. I'm from Seneca Financial Solutions and I'm here today with the man, the mustache, the mystery, Dylan Pargiter-Green. DPG, how are you, mate?
I'm well, mate. I'm well. The man, the mustache, the mystery. Hopefully I'm not too much of a mystery. I feel like I'm a pretty open book.
Mate, you always want to be a bit mysterious. We always like to be a bit mysterious.
Yeah, a little bit mysterious. How are you, mate? How's the week?
Mate, good. I had a short trip to Sydney Tuesday for the day. Did a bit of equity, mate. Did a bit of AusBiz if people want to go check that out. And then I was back in Melbourne Wednesday and then back down the coast Thursday, Friday. So looking forward to getting in the water this afternoon, potentially. You're
a media mogul, mate. What's where are you going? You going to Bells or
straight out at Bells, matey? Straight out at Bells this afternoon. High tide could be a cheeky. It's very windy here. It'd be 30-40 knot winds at the moment, but they're blowing in the right direction, so that's all that matters. Now,
out with the sharks,
mate. There was one sided at 13th Beach, but we won't talk about that.
Okay.
We're going to talk about Super instead. Good. Much more exciting.
Very, very good.
Less potentially harmful to your legs. So, deal. The end of financial year is coming up. It's the 31st of May. Today we're recording on a Friday, which is a bit unusual for us, but here we are. And it is time for financial planners to make their living, get the money in super, save all the money, save all the tax. So we're going to go through a few of the sort of common strategies for people, things they can do. What is the most common thing people are doing before the end of financial year when it comes to contributing to super and trying to save themselves some tax? Let's talk concessional and non-concessional contributions, please, my friend.
Let's do it. I mean, I think the most common thing that people do before end of financial year is call me on the 27th of June and say, I haven't done my contributions yet. What should I do? So if any of my wonderful clients are
valued clients,
please call me next week and not on the 27th of June. That being said, we are all over it. We do a big planning session the week before the start of June, and all of our clients get a plan which covers their needed contributions to make sure we're making the most of the tax deductibility. And that is what this podcast is all about.
Dylan, I'm already asleep. What do I have to do?
Well, you haven't, as we all know, you haven't put $1 into superannuation into 10 years because
that's not true. That's not true.
Luke thinks that he's going to paddle out with Crazy Swayze from Point Break before he reaches preservation age.
It's going to be all over, short and sweet.
It's not that far away from you, is it, mate?
Oh, please, come on, mate. Come on.
No, right. So we're going to talk tax deductible contributions, but we're also going to talk contributions that aren't tax deductible and the reason why they might still be an appropriate strategy.
So how much money can I put in tax deductible before end of financial year?
If you have put in 0 contributions so far, you can put up to $27,500 for this financial year.
Does that include my employer contributions, or is that exclusive of independent of my employer contributions?
That includes your employer contributions.
So if you're on $300,000 a year, you can't put anything in. You can't do it. So if you're not on $300,000 a year, you might be able to put some in. And if you're on $50,000 a year, you're probably definitely going to be able to put some in.
You can, but if you're on $50,000 a year, it's debatable whether or not you should be putting money in, because your average marginal tax rate at $50,000 is going to be less than what your marginal tax rate is overall by
inside
contributing
super.
to super at 15%.
Okay, well, look, let's just buy the buy, but you get the gist, people. It actually is not $27,500 in a year. It is up to $27,500 a year, inclusive of your monthly pay-as-you-go super deductant amount. So don't get confused on that front. Now, if I wanted to contribute more than $27,500 to super a year, how much tax do I have to pay?
So if you contribute over the concessional contribution cap for this financial year, you will pay potentially up to top marginal tax bracket on
no good.
that. And you do not want to do that. However, there is this beautiful thing that was introduced in the 2018-19 financial year called catch-up contributions.
This is the kind of thing that gets Dylan wet. It's not good.
It is something that excites me. And it excites me at end of financial year because it means that we can make significant amounts of contributions for people into their retirement savings and save a whole bucket load worth of tax.
How much catch-up can I do?
So if you were, again, provided that you were not a PAYG employee and hadn't received any superannuation over the last 5 years, the total amount that you could contribute this year is $157,500.
Okay, so in a normal human's practical sense, you take 150. So how many years is that? That's 5 years.
Five years.
5 years of catch up, but you need to account for how much your employer put in at 10, 11, 10.5, 11, and 12% per annum over that period of time.
Yeah, so let's assume, like, just for the purposes of this, you earned $150,000 a year every year for the past 5 years, and for the purposes of our maths, right? Well, let's
10%.
assume the contribution cap was $27,500 every one of those years, which it wasn't, but
it's 25, but yeah, whatever.
Yeah.
Yep.
Each of those years, you would have an additional $12,500 that you could catch up in this financial year.
Can I just do a simple one for people, because I think there's a simpler version. Say you earn $150,000 a year, and the cap used to be $25,000. Well, you've got 15 going in at 10% super anyway. Even though super's, you got to work it out properly. But let's just say super's flat 10%. Well, you could put in 10 grand a year, 5 years, 50 grand is what you could do catch up. Now, the math won't work exactly like that, but that's kind of how you think about it.
And if you're on 150 grand, your marginal tax bracket is 37 cents. So you're getting 37 cents back in your personal name on that money. The whole amount's going into super, getting taxed at 15%, which is a tax arbitrage of 22%. Now, if you can find in any investment something that gives you 22% guaranteed in a single year, please bring it to my office because I want to see it. But 22% is pure return in the form of tax that you otherwise would have paid in your personal name.
So the message here is, if you're what I'm going to call, and someone's going to message in and say, "Luke, you've lost touch with the common man," but I'm going to say, if you're what I would call a middle income earner, i.e., someone who makes like $120,000 to $280,000 a year, I would think that you need to start having a look at those catch up. If you haven't been earning that, or your salary's gone up a lot over the last 5 years, you're probably going to be in a position where you can get at least some money extra on the catch up provision into super, reduce your tax payable this year, and be happy as Larry, as they say.
So that is exactly right. But what I think is maybe more relevant to a lot of our audience, Luke, is those significant capital gains events. So realization of capital, and
if you're a Seneca client, you have lots of significant capital gains. No, still joking.
Oh God, you are a plug and play, my friend. You're a plug and play.
I'm an idiot. I'm a certified.
No, but where we use a lot of these strategies in the years leading up to retirement, and particularly where there has been the opportunity to realise a capital gain, where perhaps someone has had a few years off work, whether it be for having children or
winding down work. Like at the end of your career, you're only going to work 2.5 days or whatever.
That's right. Someone reduces their hours and therefore reduces their income. That unused superannuation contribution cap balance builds. And so when we're planning, what we try and do is look at opportunities throughout a whole life cycle, throughout accumulation, later stage accumulation, and early stage retirement, to pick the times when we want to make those realized gains and then put that money into your retirement savings so that you can further reduce the capital gains payable on that asset. A really good example of this is clients that we have who buy property at a relatively young age, but then need access to capital when they decide to start a family. We will generally wait to sell that investment property or sell down investments until we're in the financial year of mat leave or first year of the non-working spouse, because that means that we can then utilise additional superannuation contributions and reduce capital gains payable to that person. Now,
I think it just makes sense, and I think it's the same for people who take career sabbaticals, or sometimes even I've known of situations where, because of the tax payable on realizing a capital gain, it's actually worth taking a year off work. It's actually worthwhile if you've made a significant amount of money on a business in particular. It is actually worthwhile just taking a year sabbatical, and having a zero tax rate for the year.
Absolutely. Other one that we see relatively frequently is where people go and work overseas. So if someone's been working overseas for 5 years, they wouldn't have been putting in superannuation contributions.
This was me when I was overseas. Literally, I came back and my HEX hadn't been touched, and I also hadn't put any money in super.
Yeah. And so, that's an awesome opportunity where you've got 5 years worth of caps, you come back, and if you're a relatively high income earner as well, like you come back from overseas, you're earning $300,000-$400,000
Aussie equivalent.
When you come back your super's going in, employers have the opportunity to cap your super at the 27.5, so they don't have to pay superannuation guarantee on salary above a certain point.
Mm-hmm.
But you can then take that money that you're earning above that's not allocated to super, make additional contributions, and claim the tax back on it yourself. So it's a great opportunity. We've got quite a few people in our circles who have gone and worked in investments in London or America, come back working for similar companies, high income earners, and there's this golden opportunity now for them to catch up on the superannuation contributions they missed during that time, but also reduce their income, right? Reduce the income,
but reduce the tax, right?
Yeah.
Okay, so that's catch ups and your concessional stuff, and why you would use the catch up provision. What about what are the other sort of 2 or 3 major things that are happening pre-financial year that are really helping clients in your world, Dill?
Yeah, so I mean the other one is the alternative type of contribution, which is a non-concessional contribution.
Yeah.
So non-concessional contributions are after tax money. They go in and you are not taxed when you put the money into super, but of course you can't claim the tax deduction on them. So reasons that we'd be putting those contributions in is really that later life, later stage, working life type client who, wants to get as much of their wealth that they've built into what is about to be a really tax effective retirement income stream.
Yeah.
A lot of the time for clients in their 50s and 60s, the goal is to get as much of that money in as soon as possible, because as soon as they turn 60 and if they decide to retire and start an account-based pension, all of their investments, which often, for clients that we have together, we can map the same investments outside super as we have inside super. So that's a really important thing. You don't have to take your money out from the Seneca Australian Shares Fund, which I'm sure everybody has their funds in.
As if they don't, they should.
Financial advice. One thing that a lot of people don't realise is, we have clients with fairly significant investment portfolios that they've built over their years, and they think that they have to sell those assets down and put it into a big super fund. and it's not the style of investment they want. They don't want to just throw their money into retail or industry super. They still want to have their investment management. Superannuation is just a structure. We can manage superannuation money just as well as we can manage other money. And so a lot of the time we'll actually in specie those assets in as well.
Yep.
Reduce transaction costs. And then instead of realizing their capital gains at rates that would be in their personal name, they can then realize capital gains in future and income in a 0% tax environment.
Sounds pretty good. Dill, talk to me about small businesses. So, the plight of small business owners is, well known to me, in the sense of, you work pretty hard, you probably underpay yourself, you don't get as much money into super, and you're trying to build equity in your business. If I sell my business in the years leading up to retirement, what are some of the strategies I can employ to maybe get some extra money in super and get my tax-free income up in retirement?
Yeah, well, I mean, there's quite a few small business tax concessions. By holding your business for more than 10 years, you get a lot of those tax concessions anyway without necessarily needing to put extra money into superannuation. But you also have capacity to make additional superannuation contributions from the sale of your business as well. That is something that I would probably recommend that you both speak to your accountant and your financial advisor about, because your business structure is very important there. What happens when you sell your business is very important. I'm probably a little bit reluctant on a podcast to say exactly how much you can put in and all those sorts of things. But
I think it's a point for advice, and I mean we've had a few recent examples with clients, and certainly it is varied. And I think one thing I would encourage all working and younger entrepreneurs to make sure they've got across is that they set these structures up and set up their business and the way their business operates properly from the start. And
100%.
I'm helping one guy now, trying to get rid of minority shareholders, managing a pretty average shareholders agreement. It would have been much, there's a lot of things that business owners should be looking at. And you don't think about too much at the start while things aren't necessarily going gangbusters and you're not making a lot of dough and there's not much money on the line and it all seems pretty straightforward. I think putting in those foundational steps, spending the money, getting it right at the start, often, if you intend to succeed and you're going to work hard to succeed, often can pay significant dividends down the road. And I think from my perspective anyway, it's been great having someone like my business partner, John, who's been there, done that. And certainly,
he lived with the dinosaurs, so
easy on poor old JV. Leave the boomers alone.
Love you, JV.
Yeah, so look, I think we need, it's been good for me to learn that stuff in terms of when we set up Seneca, and JB and I have a little motto like do things properly. That's our sort of internal motto, and I think it definitely has paid dividends for us.
Is that trademarked?
No, it's not trademarked. But now that we're trying to do things bring in new shareholders and share the equity around for staff, I think that's really, really important, and it's working great. But only because we did the foundational stuff, and I'm sure one day when we want to sell the business, the way that we've structured it's going to also be beneficial for us.
100%. I mean, and it's no different for individuals who either own their businesses or even individuals who are in relatively high PAYG jobs, right? Setting structures up appropriately at the start is so important. If you want to build a large investment portfolio, you need to have a conversation about structure and where that's held, because having the capacity to discretionally distribute
income
and capital gains, potentially paying company tax rates instead of personal tax rates as you accumulate, like these things make hundreds of thousands of dollars of difference.
And this is where financial planning, I don't think that probably the average investment focused client actually gets the value of it.
Yeah.
It's not like there is no silver bullet with financial planning. What it is incremental gains. I saw a video on the internet. It's probably the 15th time I've mentioned this on a podcast, but I saw a video on the internet of a time lapse of Formula One Grand Prix pit changes, and they used to be like 20 seconds long, and then every season they've just got incrementally faster, and now they're 2.6 seconds or whatever they are. And I suppose all I'm trying to say here is financial planning works like that. You do a little bit of work every year to, at the end of it, end up with a lot more money and a bigger piece of the pie. And I think you don't really necessarily notice the change year to year. You don't feel any better about it, but incrementally, you're making significant progress. Probably no different to, if I think about health and fitness or lots of other things in life too.
Yeah,
so those incremental gains.
Yeah, small changes make a big impact over a long time.
You let them compound. More.
Yeah, it's all compounding. Whether or not it's investment return that you're compounding, or strategy changes, little moving little bits and pieces around.
And investment return is strategy. Like at the end of the day, I spoke to a client this morning who I've just referred to you, Dill. They're starting at the top, like this. Oh, investment returns. It's like, well, no, you need to start at the bottom, at the foundation. It's like, well, why do you have a self-managed super fund with that little amount of money in it to do nothing relevant with it? So the structures are all wrong, and the decision making is all wrong. So it doesn't matter what investment you make. It's all going to be. You're not going to get the most out of it. Exactly right. You're putting the wrong stick in the wrong hole. It's really, really simple. So and
that whole
I think
foundation thing. Yeah, build a good slab when you're building a house, and your house will probably stand up forever. Build your house on, timber stilts dug 30 centimeters in the ground. It's probably going to fall over pretty quick. So,
very good, mate. Very, very good. Is there any other end of financial year tidbits for the people, for me, for the punters out there which you think people should be thinking about?
I think, look, one of the big mistakes we see our self-employed clients is not proactively seeking a tax planning meeting from their accountants and from their advisors. So we make all of our self-employed clients have a meeting with us in May or June. It's the busiest time of year for us because of that. And it's because the income there is so variable. You really don't know what you've done for the year until you get to that point. And the things that you can do to proactively manage your sort of upcoming taxes and what your tax bill will be for the following return. Really, really important. So just plan, just do that. The other thing that I'd say is, keeping on from what you said, right? A lot of this stuff only has to be relatively small. For a lot of our clients, it's putting an extra $2,000 or $3,000 into that superannuation, so that if they're earning $230, $240, $250, there's probably not a significant drop in the. It's a drop in the ocean in terms of their.
It's not big money. Yeah,
month to month cash flow, but it is that small amount that accumulates over time. And if you can look back in 20 years and say, hey, I didn't really notice that. But I'm 100 grand better off. Happy days.
Yeah, for the benefit. Yeah, 100%. Yeah.
Now I can fly business instead of economy to Europe when I go every couple of years or whatever it might be.
Yeah, so, I also think, Dill, okay, so that's one strategy that gets you 20 grand raw into super and the compounded value of that over time. Sure, that's quite that might be 50, 60, 70, 80,000, but it's that plus 5 or 6 different other strategies that you're employing at the same time over that lifespan that do result in you having $400,000 or $500,000 more than you otherwise would. So I'm with you on the incremental gains, and I think it's important. And even how it may seem small, scratching together after tax investment returns is hard, and
100%.
And so let's anything we can do that can really that can move the dial a bit in our favor. I think that particularly at an after tax level is really important. I think from my perspective, what I don't see clients doing enough is utilizing their portfolio to help them with their tax. So, getting in touch with me and saying, Luke, is there anything here that I can do before June 30 or after June 30 that's going to make my life easier or harder? And making sure that those things are happening in an orderly fashion. I'm not suggesting, by any stretch of the imagination that we're going to be doing wash sales or anything like that, but certainly, there are going to be positions that are worth selling. There are going to be things that are, alternatives that are better and are buying, and maybe doing that before the end of June is going to be really helpful for you at a personal level elsewhere rather than something else. So, I'm more than happy to have just those conversations with clients. We do have lots of them, but it's certainly, clients should be checking with their accountant on their overall tax position, or their financial advisor with their overall tax position, and if they need help with managing that from an investments perspective, we're right there to help them. So, I think people should do that more often. Certainly, I look at every year.
Ask the question. That's what we're here for. So,
Yep.
Clients, and if you're unsure, or you don't have an advisor, like, reach out to us, reach out to someone, and just have the conversation. It's usually going to be free to have that first conversation, and you never know what you don't know. So
you don't know what you don't know.
That's a great saying. Am I right?
It is a great saying, but it's very true. And I don't know lots about lots of things, and financial planning, Dylan's much better at it than me. But certainly, I think people do think that they're supposed to just know this stuff, and they're not. They're the only one who doesn't know it. And
100%. People think that there's silos. Like, the amount of conversations we have, it's like, oh, I'm just not good at this stuff. It's like, no one's good at this stuff. I'm not good at surgery, but I don't try and do it. Right?
Yeah,
like,
I'm not good at
my appendix is a bit sore. I might just go and take that out. It's like, it just doesn't happen.
It doesn't happen. And, we're not good at lots of things. And, just because you're not good at this doesn't mean that there's no one there to help you with it. Like, I'm not good at lots of things as well. And just because you could learn it or you could know it doesn't mean that you should. And that's where you should spend your time. So, I personally think everyone should, whether it's in the global economy or the personal economy, we should all try and produce goods and services where we get the most productivity and the most value. And then we should outsource to people who do the other stuff for us, and they do what they do well. And financial advice and investments are no different. So I think that would be a wise thing to do if you haven't had it before June 30. Ideally, next week would be a great time. So Dylan and I don't come to you in like a cold sweat of like stress and anxiety, and like,
put it this way: if you call me in the last week of June,
you're not getting I'm not taking
your phone call.
You'll get a meeting with me, but it won't be before June 30th.
You get a meeting with Luke, but he's not going to tell you what to do before June. Very good.
Very good. Do any other sort of pre-June 30 type stuff we can talk about that's interesting that I've missed?
Look, probably not. I mean, do the main stuff. Don't go out and buy a bloody ute like a lot of our building clients try and do.
Why don't I want to buy a ute?
Well, I mean, maybe you do want to buy a ute. We see a lot of our clients trying to take advantage of these large depreciation opportunities.
I don't think you can get them on cars anymore, then, can you? Isn't the instant asset write-off gone?
The instant asset write-off is gone on that. There is still a small
accelerated depreciation thing.
That's right. But more often than not, people aren't considering what that actually does for them. They might already have a car that's only a couple of years old. They're not really getting that much more out of that higher asset value that they're purchasing and then depreciating. Just consider more than just your business income is what I'd say. So
yeah,
if you're trying to reduce tax in your business, think about ways that you can do that whilst also benefiting your personal assets, because that's the mistake that we see a lot of self-employed people doing.
Yeah.
They overspend within their business. They don't think about ways in which they're able to distribute and exit some of the wealth that they've created within their business during the time that they're working. And that's what leads to people not having a whole lot and needing to rely on the small business tax concessions if they're available to them.
Yeah, I think that's a really good point, Dill. I mean, just because you're going to pay tax at the end of the financial year and you're a business owner and you think, well, I can go to JB Hi-Fi and buy a new laptop, and that's just free essentially because it's given to the ATO or buy the laptop.
It's not free.
Expense the laptop. Well, you could put that money in super and be in the same situation and essentially get that money out of your business at courtesy of the ATO. So I agree. I think that at some point you've maxed out all of your super contributions and you've done everything you can do. And sometimes it is worth buying or replacing things that you do need in your business. But by the same token, I do think that people are underutilizing, let's call it more future-facing, more appreciating asset accumulation rather than Luke gets a new tax-deductible Porsche to go and see clients, which I would like, but Claire won't let me buy.
You would, yeah, and the asset depreciation on a car is only up to 60 grand, mate. So
no good to me. No good to me.
You're only going to get a quarter of a Porsche for that.
Get me one tire. Yeah, exactly right. Okay,
mate, it's been a pleasure. I've got so much work to do. It's June 1 tomorrow. I'm doing a little 5Ks every day in June, which would be lots of fun.
This running thing's got to stop. It's got to stop.
Look, not all of us only have, not all of us are walking around on the ankles of a 94-year-old, all right?
I can't, my ankles are stuffed. So
no, you go out, you paddle hard. So maybe you should go for a surf every day of June and join me on the journey.
We do a challenge that one year. Anyway, I will be getting in the water this afternoon, which I'm very excited about, mate. I've got a weekly note to go and write. And
do it
before I do that. So
Timberwolves are playing, so we don't know.
Don't tell me the score. Don't tell me the score.
No, I don't know. No.
So if you want to read the weekly note and you're into 1,000 words of ranting about markets, you can do that. www.senecafs.com.au/subscribe. Otherwise, have a lovely weekend, Dylan.
Mate, you have a ripper. Enjoy the waves. Don't get bitten by a shark.
I'll try my hardest not to. Chat soon.
See you, mate. Bye.
Bye.